So what on earth is going on with US non-farm payrolls? We've just had the data in and they've really sent markets a loop. Let's just go back a little bit and see what the setup for all of this was. We saw the ADP employment survey for February out, and what that showed was a big downward revision in the January numbers from 300 to 213 and a slight miss on February. That was expected at 190,000, came in at 183, and we got the non-farms today and we were expecting a somewhat similar pattern. We had a monstrous 304 print for January. We were expecting some considerable clawback on that, and the market was penciling 180,000 job gains for February. What did we get? Well, actually, we got the already huge 304 number marked up to 311, and we didn't get 180 for February, we got just 20,000. So markets very, very worried indeed that we're seeing a dramatic slowdown in the US job market, that we're seeing a dramatic slowdown in the US economy, and no surprise that the market's immediate reaction was to sell down equities. We certainly saw the Dow take a dip and sell down the dollar. The thing that's actually complicating matters somewhat was not only did we have very weird headline numbers on these non-farm payrolls, but the crucial average hourly earnings number was expected to have a little bit of a bounce from 0.1 to 0.3% month on month, 3.3% year on year, which is where it's been stuck more or less since October of last year. That came in at 0.4, and that's the strongest number that we've seen in quite a while. So that's not a great combination really. So potentially weaker growth and stronger inflation perhaps coming through wages. So overall perhaps a stagflationary environment. So this is potentially problematic, and it's also particularly problematic for the Fed in as much as the Federal Reserve, yes, it went out of last year kind of signaling through its dot plot that it might be willing to raise rates once by a quarter point during the course of 2019. But since then has sounded incredibly dovish. Only last week we had the chairman, Jay Powell, saying that he sounded very, very relaxed about where they were on inflation and growth, and effectively vindicated the market assumption that not only is the Fed not going to be raising rates this year, in fact, it's probably going to be starting to cut them into 2020. And of course, if we are starting to see wage inflation picking up and this pushing through into broader inflation figures, then all of a sudden that seems to be back on the table again. A rate rise was perhaps back on the table. So let's see. I mean, we've got the next Fed meeting on the 20th of March. We've got a new set of economic projections, a new dot plot. Let's see where they go with this. But one thing I will leave you with in terms of the labour market conundrum in the US is going back to another piece of data that we got during the course of this week, which was the US Beige Book for February. And what this said, quite interestingly, is he said that fewer people are actually enrolling in college. They were going straight into the job market, which I guess perhaps is a statement of what we think is the worth of a US degree these days, but also just suggesting that maybe the labour market's a little bit bigger, probably gives them a little bit more room for manoeuvre short term, although I suspect the long-term implications aren't terribly positive. Generally getting education is a good thing. But also interesting saying that a lot of employees, because of the tight labour market in the US, were pushing for non-wage benefits, things like relocation allowances, flexible working and extra vacation, which will not be picked up in the jobs data. So this is, again, a potential concern. As I said, the headline wage inflation numbers are starting to pick up, but maybe because the way that benefits are being delivered in the job market in the US at the moment, maybe this sort of data is underestimating the inflationary pressure picking up. And as I say, the market isn't discounting that the Fed is going to do much about it at this point in time. So keep an eye on those numbers.